Now, our next guest oversees more than $1 billion. He's also one of Australia's top money managers. We have Don Williams and his Platypus Australian Equity Fund being #1 in annual returns over the past 5 years. In fact, these days he's doing more selling than buying. And we welcome Don to the program this morning. A good Monday to you. Happy year of the tire. Gong hei fa choi. All the good stuff to you, Don. Let's talk about what's going on in the Australian equity markets, because it's interesting that you're doing more selling than buying these days. Pardon me. And in your January report, you actually said cash and information technology were the only major contributors to performance. So what exactly does this tell us about the current market conditions?
Well, we think this year will be a year of transition. You know, we've had a major move off the lows, and we've got to a point where valuations are reasonable, and individual companies and sectors have to show prospects of growth or prospects that we're through the worst before you can expect further share price gains. So we trimmed most sectors of the portfolio over the last couple of months and have increased the cash a little bit.
Yeah, and what about these declines in the stock markets? Don, are you a believer that we'll see deeper drops to come?
No, I think that's unlikely. We could see a correction in Australia back to 4,200 to 4,300 on the index. That'd be about a 15% fall from the top. So we wouldn't be surprised to see a deeper correction than we've had to date, but we're not looking for anything disastrous, that's for sure.
Yeah, the last time you were on was back in November, and back then you said any dips would be buying opportunities. So I guess that's still the case, right? Especially in this correction as well.
Yeah, I think so. We're about halfway through our half-year reporting season at the moment, and so far the numbers have been good. And there's nothing has come out yet that would lead you to be more downbeat on the Australian equity market. That's for sure. So if we were to correct down to those lower levels, there would be some great buying opportunities.
Okay, so you're looking for the ASX to hit maybe 4,200 in the near term, and that's why I guess you're switching more to cash. You're looking at 6% cash holdings right now, which is up from the 3% cash holdings just last month. Do you see this ratio likely to increase from here, or is it pretty much at this upper limit?
We're happy that's enough cash to take advantage of anything that props up. We might raise more cash if the market were to rally back to 4,700. We just think we're in a transition period here. The market's going to chop around. Clearly, risk appetite has declined globally over the last couple of months. So we think markets are generally going to trade sideways, and it makes sense to have a bit more cash. If we were very bearish, looking for a deeper decline, we'd have at least 10 up to 15% in cash.
Yeah, and Don, any shorts on the table right now, considering you're seeing a near-term correction coming?
No, we're a long-only fund, so we're not able to short. There are some good individual shorts in the market in Australia at the moment, but we're not able to take advantage of them, unfortunately.
All right, so let's go long only then and talk about some of these stock picks that you've told us about in the recent past. Talking about JB Hi-Fi, BHP Rio, Telstra, so Leighton Holdings. These are among some of the Australian companies that have been releasing results. What do you think of the earnings season so far? Have you been impressed and optimistic from it?
To date, the earnings estimates have gone up in the first couple of weeks. Often you get the better results early in the reporting season, so it's a good start. But there could be some worse numbers to come. As I said before, there's been nothing in this reporting season to lead you to believe that you should have, I guess, less money invested in Australian stocks. Most companies are performing quite well, and we think we'll get to the end of reporting season and the outlook will still be quite good, at least from an Australian company's perspective.
Yeah, I find it surprising that you actually took some profit on some of these stocks that I mentioned, which includes JB Hi-Fi, because you've been talking about that stock for a long time. Also Wesfarmers and David Jones, the consumer space, which the last time you were on, and really for the last few appearances, you've been quite bullish on the Australian consumer. So what did you see here that made you say, hey, it's time to sell?
The selling was more based around a market view than individual company. JB was $9 a year ago, and it rallied to as high as $24. So it just seemed logical to us to take a little bit off the table. We're more on the buy tack for JB now. It's come back to under $20, so it looks a lot more attractive, and they've also produced another good result, which gives you more certainty going forward. So we're just trading the size of the investment a little bit, and JB remains one of our largest investments in the market.
Yeah, and quickly, we have 45 seconds here, Don, but you actually bought into Commonwealth Bank but cut your holdings in ASX. Talk us through these trades quickly.
Yeah, we like CBA. It's got the highest return on equity of all the banks, and they actually upgraded their earnings recently before reporting their numbers. We think the banks generally will have a good couple of years as the amount of bad debts roll off. After that, it might get a bit harder for the banks. But over the next 2 years, we think you'll make good returns in the banks, and CBA is our top pick. Essentially,
Okay.
we think it's the best run.